Let's have a conversation around Dwayne "The Rock" Johnson's investment portfolio and the optimal beta it has. And by the way, what is your beta? Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to have a conversation with you around Dwayne "The Rock" Johnson's investment portfolio and the optimal beta it has. But I also want to talk to you about your beta, your portfolio's beta. And I'm going to show you how to calculate it, because it is important when it comes to risk management from a long-term perspective. First, let's talk about beta. What is beta? Beta essentially is a measure of the volatility, aka systematic risk, of a security or a portfolio compared to the market as a whole. So beta is used in the capital asset pricing model, which describes the relationship between systematic risk and expected return for assets, usually stocks. By the way, don't worry about all those jargons. I'm going to explain everything from A to Z. So capital asset pricing model is widely used as a method for pricing risky securities and for generating estimates of the expected returns of assets, considering both the risk of those assets and the cost of capital. So if you borrow to invest in something, the capital asset pricing model will help you understand the risk of the asset that you're buying versus the cost of the capital versus how much you're paying to the bank, the lender, in interest rate. So how does beta work? A beta coefficient can measure the volatility of a single stock compared to the systematic risk of the entire market. Here I'm talking about the Dow Jones 500, for example. So in statistical terms, beta represents the slope of the line through a regression of data points. So in finance, each of these data points represent an individual stock's returns against those of the market as a whole. So what beta does is that it effectively describes to you the activity of a security's returns as it responds to swings in the market. When the market does yo-yo, beta actually describes that activity to you. So a security's beta, a security can be a stock, a bond, a mutual fund, an ETF. ETF stands for exchange traded fund. So a security's beta is calculated by dividing the product of the covariance of the security's returns and the market's returns by the variance of the market's returns over a specified period. Don't worry, this is a little jargon here, but so we're going to put the formula on the screen so you can see it here. So the calculation for beta is as follows. So look at the formula right now. So beta coefficient equals covariance divided by variance, so covariance of RE and RM divided by the variance of RM. So RE is the return on a single stock. RM is the return of the overall market. So covariance is kind of equals to how changes in the stock's returns are related to changes in the market's returns. And the variance just sort of describes how far the market's data points spread out from their average value. By the way, folks, you don't have to calculate this yourself. Nowadays, we are so lucky. We have spreadsheets, we have apps, and you have financial websites such as Yahoo Finance that make it easy for you. They will give you all the data. You just have to enter the numbers, and they'll just give it to you. In some cases, it's even easier. The data is already there available. So things like beta, alpha, and I'll talk about alpha also later on, maybe in this show or another show, but the data is available. And the great thing is that it's not only available, it can help you actually understand risk versus returns across your portfolio. So the beta calculation, if you really think about it, is used to help investors understand whether a stock moves in the same direction as the rest of the market. It also provides insight about volatility. So it tells you how volatile or how risky a stock in your portfolio is relative to the rest of the market. So for beta to provide any useful insights, the market that is used as a benchmark should be related to the stock. And this is very important. Let me give you an example. So let's say you want to calculate a bond ETF's beta using the S&P 500 as the benchmark. You will not have helpful insight because the bond ETF has no direct correlation to S&P 500, which is a basket of stocks, right? So you will not get much helpful insight, especially if you're an investor, because bonds and stocks are too dissimilar. The correlation is not there. You have inverse correlation. So ultimately, an investor is using beta to try to gauge how much risk a stock is adding to a portfolio. This is what you should be doing. So while a stock that deviates very little from the market doesn't add a lot of risk to your portfolio, for example, it also does not increase the potential for greater returns. What I'm trying to say here is very simple. If you want to make sure that a specific stock in your portfolio is being compared to the right benchmark, you want to make sure that you have the high R-squared value in relation to the benchmark. What is R-squared? R-squared is the statistical measure that shows the percentage of a security's historical price movements that can be explained by movements in the benchmark index. So what happens is that when you use beta to find out the degree of systematic risk, the security that you're trying to gauge, the security with a high R-squared value in relation to its benchmark, would increase the accuracy of the beta measurement. Let me give you a very simple example that you can understand. Let's say you have a gold exchange traded fund, so a gold ETF, such as the Spider Gold Shares GLD. Ticker symbol is GLD. This GLD is tied to the performance of gold bullion. As a result, a gold ETF will have a low beta and R-squared relationship with the S&P 500 because of the dissimilarity that I was speaking about earlier. So one way for a stock investor to think about risk is to split the risk into two categories. So the first category is called systematic risk. That's what I was telling earlier. I'll explain that. So what is systematic risk? This is the risk of the entire market declining. So I'll give you an example. When we went back to 2008, the financial crisis in 2008, this is an example of a systematic risk event. So no amount of diversification could have prevented investors from losing value in their stock portfolios, right? I don't care if you have the most sophisticated machinery and algorithms, there's no way you would have prevented the losses back then. So systematic risk is also known as an undiversifiable risk. In other words, the risk you cannot diversify. Now let's talk about the opposite of systematic risk. You guessed it, it's unsystematic risk. This is also known as diversifiable risk. So this is the uncertainty associated with an individual stock or industry. I'll give you an example. So, for example, the surprise announcement that the company Lumber Liquidators, ticker symbol was LL back in the days, had been selling hardwood flooring with dangerous levels of formaldehyde in 2015, is a great example of unsystematic risk. If you think about it, because this was risk that was specific to that particular company. So unsystematic risk can be partially mitigated through diversification. So now you kind of understand how to calculate beta, how it works. Let me just talk now about the types of beta values so that you can compare that to your own portfolio and sort of figure out where you are in terms of risk tolerance or risk management and analysis. So you have beta value equal to 1. So if a stock has a beta value of 1, this indicates that its price activity is strongly correlated with the market. So if you have a stock with a beta of 1, that stock has systematic risk because God forbid something happens, the entire market crashes, you bet that stock is going to crash too. However, the beta calculation cannot detect any unsystematic risk. So adding a stock to a portfolio with a beta of 1 does not add any risk to the portfolio, but it also does not increase the likelihood that the portfolio will provide an excess return. So you just mimicking the movement of the entire market. That's what you're doing. If you're adding a stock with beta 1 to your portfolio, that's what it is. What about when you have a beta value with less than 1, negative beta? So a beta value that is less than 1 means that the security is theoretically less volatile than the market. So if you include the stock in your portfolio, it will make it less risky than the same portfolio without a stock. For example, let's take utility stocks. Those often have low betas because they tend to move more slowly than market averages. When you have a beta value greater than 1, So a beta that is greater than 1 indicates that the security's price is theoretically more volatile than the markets. For example, if the stock's beta is 1.2, it is assumed that, at least investors will assume, that the stock is 20% more volatile than the market. So technology stocks and small cap stocks tend to have higher betas than the market benchmark. This indicates that adding the stock to a portfolio will increase the portfolio's risk, but it may also increase its expected return. By the way, when you hear the term small caps stands for small capitalization, and this applies to companies that have a market capitalization between 300 million and 2 billion. And from 2 billion to 10 billion, that's when you talk mid capitalization. And above 10 billion, that's what you have the large caps, the large capitalization. Now, what is let me just talk about a negative beta value. So because some stocks have negative beta, so a beta of -1 means that the stock is inversely correlated to the market benchmark. So this stock could be thought of as an opposite mirror image of the benchmark's trends. So put options and inverse ETFs are designed to have negative betas. So there are also a few industry groups like gold miners where a negative beta is also common. What is a simple beta definition? Because this is something I want you to like the takeaway here. Stock beta is a measurement of the volatility of a stock as compared to the volatility of the market. I already said that before, but the thing here is that for you to really know the stock's beta in your portfolio, you need to analyze the performance of each stock in the past in order to evaluate how its price might move in relation to the overall market. So calculating the beta coefficient for a particular stock in your portfolio can help to determine how its returns react to market swings now and in the future. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Key. We're also having a conversation here around Dwayne "The Rock" Johnson's investment portfolio and its optimal beta. And I'm just going through the whole notion of beta, asking you about the beta of your own portfolio. And we're gonna get to The Rock's investment portfolio later on, but I first need to walk you through what people mean when they talk about beta, investment beta. Now, why is portfolio investment important? Why is portfolio beta investment important? So I've been talking to you about stocks beta. You want to know, now I'm sure you have clarity around the beta of the stocks in your portfolio. Now let's talk about the whole portfolio, the beta of the whole portfolio. Portfolio beta allows you to gain a better understanding of the risks in your portfolio, as well as your ability to tolerate risk. So we're going back to what I said earlier, risk tolerance plays an important role when it comes to risk management and long-term investment. So portfolio beta also allows you to acknowledge which investments match your risk tolerance level and which do not. So investors who are risk averse tend to put their money into assets that have low beta coefficients, such as treasury bills and utility stocks. Investors who are able to tolerate a higher degree of risk tend to invest in stocks that have higher beta coefficients, like the tech stocks. So let's talk about risk and age, because when we talk about risk and long-term investment, you got to put the chronology in the equation, the age. So people who are younger can take on more risk than those who are nearing their retirement age. So if you are in your 20s and 30s, you're not going to think the same way risk-wise than someone who is in their 50s or 60s. So the thing here is that research has shown that only 36% of millennials are willing to take on risk. By contrast, 45% of members of Generation X are willing to take on more risk with their investments. The percentage drops again as people age, as shown by the generation of baby boomers, where 31% are willing to take on more risk. What's the bottom line here? The bottom line here is that the percentage of people who are invested in the stock market has remained above 50% since for the last 20 years. So most recently, 55% of adults in the US had some stock market investments. So we talked about this is for risk and age. What about risk and beta? So beta investment is used as an indicator of systematic risk, volatility, and market risk. The systematic risk is the risk that is intrinsic to the entire market. I already said that. So it affects the general market and not just a particular stock of industry. So you cannot avoid that. Now, hedging is a way to minimize this type of risk, which is offsetting one investment against another. So your asset allocation strategy can also help to diminish the systematic risk by apportioning your assets according to your goals, levels of risk tolerance, and your time horizon. As we were talking about asset allocation, what is it? What is asset allocation? This is something you need to understand clearly here. Asset allocation means that how you are divvying up your money in your portfolio across asset classes. You usually have 3 asset classes. Some people go all the way to 5, but the 3 primary asset classes are cash, stocks, and bonds. Now, if you want to go to 5, you might want to add real estate and then the alternative investments. So the thing here is that based on your age, based on your financial goals, you might want to choose an asset allocation that is appropriate. So for instance, you can see people actually have, if somebody is in their 30s, for instance, still young and kicking and working hard, that person might say, listen, I want to play 60, 30, 10. That means that he or she is going to put 60% of the money into stocks, 30% into bonds, and 10% into cash and cash equivalents. So cash equivalents means everything that, so it means stuff like high yield savings accounts, certificates of deposits. You also have money market funds, and you also have short-term bond funds, right? So this is, but if the person is in his or her 50s, you probably have the things reversed around. So you have 30, 60, and 10. So you have 60% in fixed income securities, including bonds and U.S. Treasury and U.S. notes, and 30% in bonds, and 30% in stocks. And those stocks can even be in stocks with low beta. For instance, utility stocks and banking stocks, for example. And this is very important because there is a possibility that an investment's actual return will be different from its expected return. So investment beta includes the possibility that you will lose some or all of your original investment amount. Different types of risk can be measured by calculating the standard deviation of the average returns or the previous returns of an investment. So a stock's price variability should be considered when you are assessing risk. So to determine, for example, the short-term risk of a stock, you want to use the beta coefficient and the price volatility. Speaking about volatility, what is it exactly? Volatility, we hear this word all the time. There's even the CBOE has something called the VIX index that tells you a lot about how volatile the market is overall. So volatility is very simple. This is the measurement of the distribution of returns for a particular index or security. So assets that are more volatile are considered to have a higher risk than assets that are less volatile. This is because the price is expected to be unpredictable for volatile assets. So you can actually calculate how volatile a stock is and the systematic risk by calculating its beta coefficient. So going back to the beta coefficient, we already said that before. I explained to you, I showed you the formula, just so you know. Again, we're going to put it again on the screen. So you have beta coefficient actually equals covariance of RERM, right? And then divided by what? Divided by the variance of RM. I'm not going to go through this again. I already explained to you, but this is how it's very helpful for you to understand volatility vis-a-vis your portfolio. The bottom line here, folks, is when we talk about investments, whether it is the investment portfolio of Dwayne "The Rock" Johnson's or your own, you have to remember 3 things. You got to remember your risk tolerance. You got to know your financial goals. And most importantly, you have to know the movement, the beta or the risk levels of all the holdings you have in your portfolio, whether you have bonds, stocks, alternative investments, ETFs, index funds, mutual funds. The list goes on. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're also having a conversation here around beta, and we want to really have this conversation very clearly so that everybody can understand what's really happening when it comes to beta. Now, what is the formula? for beta. I gave you a different formula for beta, but investors, and that's the greatness of this market here, investors actually have several ways to calculate beta. And I'm going to show you, I gave you the finance, quote unquote, the finance formula before. Now let's talk about other ways to calculate beta in case you are interested in verifying the validity, the accuracy of your beta number. You have 2 or 3 ways to calculate the beta, so that you can, if you try those 2 and 3, you get the same number, then you know for sure that you are on the right path. So beta in finance can be calculated by using something called regression analysis. So this, what it does is that it helps to place a value. So it's very important before doing that, you need to place a value on assets when you are comparing 2 or more variables. So the formula for calculating portfolio beta is as follows. So beta equals covariance divided by variance. I already said that before. Now let's see how it really breaks down. So calculating beta finance is not too difficult and can be done with a spreadsheet program and some market data. You can even use an app. You can even go to websites such as Yahoo Finance and Market Watch, or even Bloomberg. So to calculate the beta coefficient of a single stock, you'll need to gather the daily closing prices over a given period of time. You can even use your own, you can even use the stocks in your own portfolio. You'll also gather the daily closing prices for a benchmark market index over the same time period. This can be the S&P 500, for example, right? Or the Dow Jones 30 also. So next, you need to calculate the daily price change for both the target stock and the market index. So these are calculated separately using the following formula. So you take today's price minus yesterday's price divided by yesterday's price times 100. So after you have calculated the daily price changes for both your stock and for the market index, in this case S&P 500, you want to compare how the stock and the index have moved together relative to how the index had moved alone. So the result is the stock beta. So the formula for calculating is, I already gave it to you, is covariance divided by variance. So this can also be expressed, if you think about it, as the stock's daily change and the index's daily change divided by the index's daily change. So the important thing here is that when you use this formula, you have to understand that if the stocks in your market, the stock in your portfolio rather, if let's say the market has a beta of 1, so individual stocks are ranked according to how much they depart from the market standards. So stocks with lower betas are considered to have less risk. So again, going back to your risk tolerance, if you are in your 50s or 60s, or even if you're younger, even if you're in your 40s and 30s and you are more on the conservative side of the risk spectrum, you want to add a lot of stocks with lower betas in your portfolio. Higher beta stocks such as tech stocks, startup stocks, IPOs, those are riskier, but they have the potential for higher returns. So stocks that deviate more than the market value over a length of time, let's say 5 years or 10 years, will have betas of above 1. And this is very important to distinguish them, because you want to know exactly where your portfolio stands in the whole in the whole process here. So the market against which you measure beta is a stock index. I said before, it can be DJIA 30, it can be S&P 500. So I would say just in general, this is just across the board, even non-American investors, they use the S&P 500 to measure beta because of its large number of large cap stocks, as well as a vast number of different sectors. So I've been talking to you about alpha and beta, and I want to talk about the difference. I spoke earlier at the beginning of this show about alpha. Alpha is an important portfolio metric also. Alpha and beta are both commonly used to measure performance. So alpha measures the excess return or active return of an investment or a portfolio. Beta measures the volatility of a portfolio or security as compared to the market. So both alpha and beta look at the past performance of a stock or a portfolio. So the analysis here is retroactive, not proactive. It is retroactive. However, This cannot guarantee that the stock or portfolio will perform the same in the future. That's for sure. We know that. That's the basic disclaimer that the SEC wants all mutual fund or all security issuers to put, right? Past performance is not synonymous with future performance. Now, what about the beta finance and types of risk in stocks and portfolio? So beta finance recognize several levels of risk, including aggressive, moderate, and conservative. Going back again to risk tolerance. So aggressive portfolios, you usually see that in the younger population of investors. Those carry a high risk but high reward proposition. So the beta finance for aggressive portfolios means that the stocks tend to have a high beta of sensitivity to the overall market. Portfolio that carry a moderate risk, those are usually, when you think about moderate risk, you're talking about 50-50 or 40-40. So you have 40% stocks and 40% bonds, and then you have the rest of the value of the portfolio value in cash and cash equivalent. So it'll be 20. So this kind of, if you have this kind of setup, you have in the portfolio a medium amount of risk and a time horizon of longer than 5 years. So you can do this very safely if you are in your 50s, for instance, or even your 40s. That's pretty fine. Now, investors who are more conservative with their portfolio may choose defensive stocks. So stocks that do not have a high beta are fairly insulated from large market movements. So cyclical stocks are the most sensitive stocks to the underlying economic business cycle. Cyclical stocks, you have to think about stocks such as in the travel industry, travel and hospitality. We all know what happened when in March and April 2020, when there was some kind of, I would say, quote unquote, a small chaos in the market owing to COVID-19. You saw how hotels and the entire travel industry was affected, adversely affected. So this is the importance, or at least the kind of stuff you have when you buy cyclical stocks such as travel stocks. So the benefit of purchasing cyclical stocks is that they offer an extra layer of protection against negative events. However, it depends on the kind of negative events we're talking about. So when you have a global pandemic, then everybody is affected because you have a systematic risk. So beta investors in general are passive investors. So people who use beta finance are normally not looking to outperform the market, just trying to grow their portfolio by single or double digits every year. That's it. So I've been speaking a while now about beta, and I want to talk to you now about the pros and cons. So we have beta has benefits and limitations. As every investment metric, you bet there are some limitations. Now, so beta can be a great measure of risk for short-term traders who are looking to buy and sell stocks. It can also be very useful to help you with properly diversifying the investments in your portfolio. That's for sure. It has some limitations, however. So beta lays out recent information such as new debt or an insufficient price history. So beta also relies on past information, which, as I said earlier, does not guarantee the continued or stronger future performance of a stock. So the past price fluctuations of a stock are a poor future predictor. Past data is not a good predictor of future beta at all. So the measurement of beta on a single stock tends to be volatile over time. Another limitation here is that beta is also not a good choice for long-term investors. What about smart beta? This is something that we've heard about in the hedge fund industry, in the private equity industry, or in the asset management industry. So smart beta combines the benefits of passive and active investing strategies. So the approach here is very simple. The thing here is that it is simple, but it also differs from investor to investor. For instance, in 2019, funds that used the strategies commanded nearly $900 billion in total cumulative assets. So the strategy attempts to use certain performance factors in order to try to outperform a benchmark index, for example, the S&P 500. And the smart beta tactics apply a series of objective, rules-based factors for each index's company. So they are then ranked and weighted based on specific factors. So we're actually talking about a strategy that emphasizes capture rate investment factors or market inefficiencies in a rules-based way. So traditional market cap weighted indexes like the S&P 500, they place their weight solely on the market caps, right? And this makes sense because this is what they were built for. So this gives larger companies a bigger slice of the index, even when they are considered to be overvalued. So investors may also use alternative weighting measurements such as quality, volatility, value, size, liquidity, and momentum. So these strategies are used to allocate and rebalance portfolio holdings, and they also seek to improve your return and your diversification, as long as reducing the risk by helping you to invest in customized indexes or ETFs, exchange traded funds. So the goal here is what? The primary goal is to attain alpha, right? In other words, to outperform or have less risk than traditional benchmarks. However, these smart beta tactics tend to have lower expenses than an active fund. So the strategies are good for investors that favor factor diversification, such as equity, fixed income, aka bonds, commodities, and multi-asset classes. So whether you choose this type of beta strategy should be determined based on your financial objectives, your time horizon, your risk tolerance. So your portfolio beta provides you with the one way to determine the degree of which you carry risk. So you have to think about that. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We have been talking about beta, portfolio beta, and by now, I'm sure you understand how to calculate your own beta, your own portfolio beta. Now, let's talk about Dwayne "The Rock" Johnson's investment portfolio. So, Dwayne Johnson and his ex-wife, Danny Garcia, have a growing business empire, which now spans everything from production, live events, and tequila. By the way, can you imagine? Garcia is his business partner, former spouse, and longtime manager. Isn't that cool? How many exes can you think about who can keep such a relationship? I personally find it wonderful. It's just great that they were able to move beyond the marital lengths and still keep some great relationship in business and as parents, because they have a child also. So let's just go through the list of holdings that Dwayne "The Rock" Johnson's had, that he has at the moment. You first have $7 Production, that has been behind productions such as The Titan Games on NBC, Ballers with HBO, Jungle Cruise with Disney, and Hobbs and Shaw through Universal. You also have the Project Rock with Under Armour. That's the clothing line. You have $7 Digital Studios. This is the digital media brand of Dwayne "The Rock" Johnson's. You have Athleticon, a very, very successful multiple-day live event that combines athletics, wellness, and entertainment. You also have Siete Bucks Spirits. This is the Teremana Tequila brand. You have Voss Water. This part is overseen by Garcia. So Voss, if you're curious about it, this is a Norwegian-based brand of artesian bottled water from the village of Vanestrom in Eveland municipality, and the county is Øst-Agder. I apologize to my Norwegian listeners and viewers. We really appreciate the attention, but I haven't learned my the basics of pronunciation in your language. So yeah, but we're talking about Voss. And then you also have Adam Tickets. This business is also overseen by Garcia. So Adam Tickets is a company based in Santa Monica, California, that sells movie tickets and services through its app and website. Next, you have the Garcia companies. This is led by Garcia herself, and TGC Management, also led by Garcia herself. What's my point here? The point here is that you have a large and diverse portfolio. When we talk about Dwayne "The Rock" Johnson's investment portfolio, we're not talking about only 2 or 3 items here. As we can see with a lot of the celebrities who are very smart about their money, smart on screen and smart off screen, they diversify and they have multiple sources of income, not just one, not just two, not just three. You want to have 6, 7, 8, 9, 10, so that if something happens, you are covered. And that's what we see here. So $7 production, right? Project Rock with Under Armour, $7 the digital studio, Athleticon, $7 Voss Water, Adam. So the whole 9 yard, and that's fantastic. So let's now talk about, let's kind of recap the Rock's investment portfolio. Let me recap that. As you can see on the screen right now, do you see it on the screen? We have here that the Rock's investment portfolio has at least 6 categories, at least. So you have number 1, in the entertainment, so TV. That you have the $7 production, right? And then you have, he's also involved in the fashion industry with Project Rock, with Under Armour. And then you have 3 digital assets. You have $7 digital studios, Athleticon, and Atom Tickets. 4 holding category, you have beverages. So you have $7 spirits, and then you have Voss Water. Now Voss Water is overseen by Garcia, his ex-wife, but chances are he has holdings, he has equity in it too. And then there are the other category. This is where you have the Garcia company and TCG management. Again, those are led by Garcia, but one can imagine that Dwayne The Rock has some kind of equity or some kind of involvement in it. Now, what about other investments? Of course, the instruments in his portfolios that I've been talking about, those are publicly known, which is why we were able to actually do the research there. But I'm sure there are other investments. Dwayne The Rock Johnson is a very smart man. He is surrounded by great people. He has lawyers, he has accountants, he has investment managers, he has wealth managers, and I'm sure this very expert bunch can lead him, can guide him, and tell him what to think and tell him where to invest. So we assume the team that did the research assumed that Dwayne The Rock Johnson has in his portfolio stocks, bonds. He might be having some alternative investments. He might be investing directly in some companies privately, so private equity ownership. So we believe that the whole 9 yards is here. The whole 9 yards is definitely here. And the bottom line here, folks, is that you have to analyze this to see, okay, here is a man, he is involved in various fields, and those fields are not related at all. I don't see any direct correlation between fashion, for instance, and digital assets. So what are we talking about? Just to recap and kind of close today's conversation. The Rock Inc., $7 by the numbers. We just took one. And this, by the way, this screenshot came from a Hollywood Reporter. That's the source. And we're talking about only one of his businesses. So you have $7 by the numbers. So you have 11 billion. This is Johnson's total worldwide box office, including 2017's Jumanji reboot, which grossed an overall 965 million. Folks, nearly $1 billion. That's fantastic. And then you have 10 million. This is the modest budget for Fighting With My Family, co-financed by the UK's Film 4 and the Worldwide Wrestling. So the film was bought by MGM for 17 million. So think about it. A nice change here. 10 million production, 17 million purchase. And then you have 13 $7 projects due in 2019 and 2020 across film, TV, and digital, including Hobbs and Shaw and the Titan games. And then you have $7. Now, why are we talking about $7 and Siete? You heard the thing about how the entity that manages their Teremana tequila is called Siete. So you have, when it comes to Dwayne The Rock Johnson, you have the number 7 coming back over and over, and it's because all the $7 is all the money Johnson had when he was cut by the Canadian Football League's Calgary Stampeders. So that league, when they cut him off, he only had $7. So now the big question is, which is the premise of today's show, what is then the Rock's portfolio's beta? The thing is, we don't have access to all the financial statements of all those investments that I've just spoken about, because those are private businesses. However, judging by the diversified portfolio The Rock manages with his ex-wife, it is safe to say that they are maintaining an optimal beta. Remember that beta is a measure of the volatility or systematic risk of a security or a portfolio in comparison to the entire market or a benchmark. So the question is, can we say that The Rock's investment portfolio could be subject to volatility or systematic risk? The answer is, of course. There is no investment without risk, right? However, with the level of diversification that he has, most experts will say that overall portfolio volatility, aka the beta, will be optimal. For example, I think I said that earlier, entertainment is not perfectly correlated to fashion, according to research from Wall Street analysts who cover these two industries. And the same holds true for beverages and digital assets. We checked with some friends of ours who work in the industry. So they said, yeah, beverages and digital assets are not correlated. So the only correlation we can see in Dwayne The Rock Johnson's in his portfolio, the only correlation we could see is between entertainment and digital assets. In other words, poor performance in, say, $7 production, this is the entertainment part, could correlate with poor performance in $7 digital studios, the digital assets. So beta could be positive or negative and combines elements of return, volatility, and direction. Remember though that portfolios can also have betas greater than 1, such as a portfolio with a beta of 1.25 would be expected to earn 125% of the market return, and so on. So we can assume that Dwayne The Rock Johnson's investment portfolio has a beta that is higher than 1, because he's invested in various fields, and those fields are not perfectly correlated, and he's a very successful man. All right, folks, I will see you next time. Thank you so much for listening, and until next, remember, stay marvelous.